Episode 4, Collective Investments. Welcome back to Money Matters. I'm your host, and this is Episode 4, covering Chapter 4 of the International Certificate in Wealth and Investment Management, Collective Investments. In the previous episode, we explored the full range of individual asset classes: cash, bonds, equities, property, derivatives, commodities, and digital assets. Today, we zoom out and ask, rather than buying these assets one by one yourself, what if you pooled your money with thousands of other investors and let a professional manage it all? That's the world of collective investment.
This chapter covers approximately 7 of the 100 exam questions and is split into 2 major parts: investment funds, the mainstream collective vehicles, and other investment vehicles, including structured products, hedge funds, private equity, and Islamic investment through sukuk. Let's get started.
Section 1. The case for collective investment. Let's begin with the fundamental question: why invest collectively at all? Imagine you have $3,000 to invest. You want to buy shares in 30 different companies for diversification. That's $100 per company. But with minimum dealing commissions of, say, $10 per trade, you'd spend a third of your money just on transaction costs. The maths simply doesn't work for small investors trying to build a diversified portfolio directly. But if you pool your $3,000 with thousands of other investors into a collective investment scheme, your combined pot might be hundreds of millions. Now, you're buying shares in 80 or more companies. The commission is negligible as a proportion of the fund, and your individual holding in any one stock might be just 1.5%, much less than the 3 to 5% you'd typically hold in a direct portfolio. If one stock collapses, the impact is far smaller.
This is the core logic of collective investment. The benefits are significant: economies of scale in trading and administration, genuine diversification across sectors, geographies, and asset classes, access to professional fund management, access to markets or strategies that would be impossible for most retail investors to access directly, regulatory oversight in most cases, potential tax advantages, and liquidity, the ability to enter and exit with relative ease.
But it's worth noting that diversification has its limits. In times of market stress, correlations between asset classes tend to rise. In 2022, for instance, both equities and bonds fell simultaneously, driven by soaring inflation and rising interest rates, which defied the usual expectation that they'd move in opposite directions. Collective investment doesn't eliminate risk, it manages and distributes it.
There's an important distinction between active and passive investment management within collective funds. Active fund managers make deliberate decisions about which investments to hold, aiming to outperform a benchmark index. They research companies, assess valuations, and build portfolios that differ meaningfully from the market. For investors who don't have the time, skill, or inclination to do this themselves, active funds offer a solution. However, the quality of active managers varies enormously. Advisors need to rigorously assess performance records and understand whether any outperformance is down to genuine skill or just luck and market timing.
Passive funds, often in the form of exchange-traded funds or ETFs, take a different approach. They aim to track the performance of a specific market index, rather than beat it, by simply holding the same securities in the same proportions. The appeal is straightforward: lower fees, greater transparency, and broad market exposure without the risk of a manager underperforming their benchmark. The downside is equally clear. When markets fall, passive funds fall with them.
Before diving into specific fund types, let's clarify the distinction between authorized and unauthorized funds. In most markets, regulators authorize certain collective investment schemes for sale to the general public. Authorized funds must meet specific criteria. They must be sufficiently diversified, invest only in permitted asset classes, and comply with disclosure and governance requirements. Once authorized, they can be freely marketed to retail investors.
Unauthorized funds, also called unregulated funds, are perfectly legal but cannot be marketed to the general public. They're typically restricted to professional or institutional investors or wealthy individuals who can understand and bear higher risks. Hedge funds and private equity vehicles typically fall into this category.
Section 2. Open-ended funds. The most common type of collective investment vehicle is the open-ended fund. As the name suggests, the fund can expand or contract in size. When investors buy in, the fund creates new units or shares. When investors sell, those units or shares are redeemed and cancelled. The fund's size is therefore driven by investor demand.
The price at which units or shares are bought and sold is based on the net asset value, the NAV. The NAV equals the total value of the fund's underlying portfolio, plus cash minus liabilities such as fees. Divide that by the number of units or shares in issue, and you get the NAV per unit or share. That's the fair value at which investors transact.
One important nuance. Unlike shares in listed companies, which can be bought and sold throughout the trading day at continuously changing market prices, most traditional open-ended funds transact only once per day after the NAV is calculated. This means you won't know the exact price at which your order will be filled until after the fact. Open-ended funds come in several forms depending on the country and legal structure.
In the United States, the most familiar form is the mutual fund. U.S. mutual funds fall into three main categories: money market funds, which invest in short-term instruments for safety and liquidity; bond funds, which focus on fixed income securities; and stock funds, which invest in equities. U.S. mutual funds are technically open-ended companies under federal securities law.
In Europe, the dominant framework is UCITS, Undertakings for Collective Investment in Transferable Securities. UCITS is a European Union regulatory framework originally designed to allow investment funds to be sold across the entire EU on the basis of authorization in one member state. A UCITS fund complies with EU rules regardless of which EU country it's established in. The UCITS brand has become globally recognized as a quality mark, making these funds acceptable for sale in markets well beyond Europe, including Hong Kong, Singapore, and much of the Middle East.
The main hub for UCITS funds is Luxembourg, the most popular center for funds distributed across European borders and globally. Major US and European fund groups manage enormous fund ranges from Luxembourg, selling to investors across Europe, the Middle East, and Asia. The two dominant European fund structures are the SICAV and the FCP. A SICAV, Société d'Investissement à Capital Variable, is the corporate equivalent of a UK open-ended investment company. It's a company with variable capital. An FCP, Fonds Communs de Placement, is a contractual structure without legal personality, more similar to a unit trust. Both are common in Luxembourg.
In the UK, the two main open-ended structures are unit trusts and OEICs. A unit trust is established as a legal trust. The trustee is the legal owner of the fund's assets, holding them for the benefit of the unit holders who are the beneficial owners. The unit trust manager decides what to buy and sell within the fund and also provides a market in units, pricing them daily based on the NAV. Unit trusts are dual-priced. They quote both a bid price at which the manager buys units back from investors and a higher offer price at which investors buy in. The initial charge is embedded in the spread between bid and offer.
An OEIC, open-ended investment company, is similar in function but structured as a company rather than a trust. Investors hold shares rather than units. OEICs are typically single-priced, meaning there's one price for both buying and selling, based on the mid-market value of the underlying assets. Any charges are applied separately. OEICs are managed by an authorized corporate director and overseen by an independent depositary who holds the assets and monitors the manager's activities. a structure closely parallel to the trustee in a unit trust.
Open-ended funds charge fees in various ways. The initial charge, also called front-end load or preliminary charge, is deducted when you invest, expressed as a percentage of the amount invested. Exit charges, or back-end loads, may be deducted when you sell. The annual management charge covers the ongoing cost of running the fund, and the ongoing charges figure, the OCF, is the most comprehensive and meaningful measure, covering all running costs as a percentage of the fund's assets. When comparing funds, always look at the OCF, not just the headline management fee.
Performance-related fees reward managers who generate returns above a certain threshold, aligning the interests of manager and investor, at least in theory. But they can add meaningfully to costs in strong years. One more feature of open-ended funds. They can offer both income and accumulation units or shares. Income units pay out the dividends and interest earned by the fund as regular cash payments. Accumulation units reinvest that income back into the fund, compounding the growth over time. Many funds offer both, allowing investors to choose based on whether they need regular income or prefer to maximize long-term growth.
Some open-ended funds invest not in individual securities, but in other funds. These are called funds of funds, or FOFS. A fund of funds appoints a single overall manager who selects and allocates across a portfolio of existing investment funds, seeking the best managers in each asset class or sector. Most funds of funds are unfettered, meaning the manager can choose from any external fund on the market. Some are fettered, restricted to investing only in funds run by the same management group, which obviously limits the universe of choice and introduces potential conflicts of interest.
A related concept is the manager of managers, or MOM structure. Unlike a fund of funds, a MOM doesn't invest in other funds. Instead, it appoints specialist external fund managers to run segregated mandates in their respective areas of expertise. The potential benefit is more direct access to top-tier managers, but the minimum investment is typically much higher and it's harder to switch away from an underperforming manager quickly.
Section 3. Closed-ended investment companies. Closed-ended funds are fundamentally different from open-ended funds in one key respect: the capital is fixed. When the fund is launched, a set number of shares is issued to investors through an initial public offering. After that, those shares are listed and traded on a stock exchange, just like ordinary company shares. New investors don't buy from the fund manager. They buy from existing investors in the secondary market.
This creates an interesting dynamic. The price at which a closed-ended fund's shares trade on the stock exchange is determined by supply and demand, not by the NAV of the underlying portfolio. As a result, the shares can trade at a premium to NAV, meaning investors pay more than the underlying assets are worth, or at a discount, meaning they can effectively buy a pound's worth of assets for less than a pound. Most investment trust shares trade at a discount. The size of that discount reflects market sentiment about the quality of the fund's management and the attractiveness of its underlying investments. When an investment trust is approaching its winding-up date or is subject to a potential merger or takeover, the discount often narrows or disappears.
Many investment trusts run discount control mechanisms, buying back their own shares in the market to reduce the discount, and premium control mechanisms, issuing new shares to reduce a premium. These help keep the market price aligned with fair value. In Europe, closed-ended funds are typically known as investment trusts or investment companies. The first investment trust was established in the UK in the 1860s, and the Foreign and Colonial Investment Trust, set up in 1868, is still operating today, making it one of the oldest investment vehicles in existence.
One of the structural advantages of investment trusts over open-ended funds is that the manager isn't forced to buy or sell assets to accommodate investor flows. A unit trust manager must invest new cash when it comes in and sell assets when investors redeem, even if market conditions are unfavorable. An investment trust manager is insulated from this pressure, as investor transactions take place in the secondary market without touching the fund's underlying portfolio. Investment trusts can also use gearing, borrowing money to invest, which amplifies both potential returns and potential losses. This is not typically permitted for retail open-ended funds.
Some investment trusts are split capital trusts with more than one class of shares. For example, income shares that receive all the fund's dividends and capital shares that receive all the capital growth at wind-up. This allows investors to tailor their exposure to income or capital return.
Section 4. Exchange-traded funds. ETFs are a hybrid. They combine the diversification and professional management of a traditional open-ended fund with the real-time tradability of a listed share. ETFs are listed and traded on stock exchanges, and their prices update continuously throughout the trading day. Liquidity is provided by market makers who continuously quote prices.
Most ETFs are passively managed. They track a market index. Popular examples include ETFs tracking the FTSE 100, the S&P 500, or government bond indices. Because they simply replicate an index, they don't require expensive active research and portfolio management, which translates into very low fees, sometimes just 0.05% to 0.20% per year for broad market ETFs. ETFs also offer transparency. The holdings are disclosed daily, and flexibility, since you can buy or sell them at any point during market hours at a known price.
There are several ways ETFs can replicate their target index. Full physical replication means the ETF holds every single constituent of the index in exactly the right proportions. This is precise but expensive, especially for large indices with many constituents. Stratified sampling means the ETF holds a representative subset of the index, reducing transaction costs while keeping the tracking error low. Optimization uses computer modeling to select a basket of stocks that closely mimics the risk-return characteristics of the full index, useful for indices with hundreds or thousands of components. Synthetic replication is a fundamentally different approach. The ETF enters into a swap agreement with a counterparty, typically a major bank, who agrees to deliver the index return in exchange for the return on a basket of collateral assets. Synthetic ETFs can reduce tracking error and access markets that are difficult to replicate physically, such as certain emerging markets or commodities, but they introduce counterparty risk. UCITS rules limit exposure to any single swap counterparty to 10% of the fund's NAV.
An important metric for all tracking funds is tracking error, the degree to which the fund's returns deviate from the index it aims to track. A small tracking error is always preferable, but some deviation is inevitable because of management costs and the real-world challenges of trading. Some ETFs go beyond simple index tracking. Smart beta ETFs combine passive and active elements. They follow an index, but one constructed using factors beyond simple market capitalization, such as value, momentum, low volatility, or quality. This allows investors to target specific risk premia without paying full active management fees.
Related to ETFs are exchange-traded commodities, or ETCs. ETCs track the performance of individual commodities, like gold, silver, or oil, or commodity indices like the S&P GSCI. They're traded on stock exchanges like ETFs, with market maker support ensuring liquidity. ETCs can be physically backed, meaning the ETC actually holds the physical commodity or commodity futures, or synthetically constructed through derivatives. Investors must understand the structure and its associated risks before investing.
Section 5. Structured products. Structured products are investment products, sometimes called structured notes or market-linked notes, that combine bonds and derivatives to create customized risk-return profiles. They've been around for decades, serving both mass retail investors and ultra-high-net-worth clients seeking bespoke solutions.
The basic concept is straightforward. Imagine a 5-year structured product with 100% capital protection. The product manager takes your investment, say £1,000, and splits it into two parts. Most of the money, perhaps £800, buys a zero coupon bond that will mature at exactly £1,000 in 5 years, guaranteeing the return of your capital. The remaining £200 buys a call option on a stock market index. If the index rises over 5 years, the option pays out and you participate in the upside. If the index falls, the option expires worthless. But your capital is still returned in full by the bond. This elegantly delivers what many cautious investors want: market participation with capital protection. But the trade-offs are real. You won't capture the full growth of the index because part of your money is tied up in the bond. You typically can't access your money early without penalty, and you face counterparty risk. If the issuer of the structured product fails, the protection may not materialize.
There are three main categories of structured product. Structured deposits are essentially deposit accounts where the return depends on the performance of an underlying index. They may benefit from deposit protection schemes as they're on the issuer's balance sheet. Structured capital protected products are similar, but usually offer higher potential returns and are typically off-balance sheet, meaning deposit protection may not apply. And structured capital at risk products, SCARPS, offer the highest potential returns, but introduce the possibility of losing some or all of your capital if the underlying index falls below a specified level.
The key disadvantages of structured products are high embedded fees that erode real returns, capped upside that limits participation in strong markets, illiquidity. Once you're in, it's often very hard to get out before maturity, and counterparty risk, especially where the product is off-balance sheet for the issuer.
Section 6. Hedge funds. The term hedge fund conjures images of secretive, high-risk speculation, and while some hedge funds do take on significant risk, the reality is more nuanced. Hedge funds were originally designed to reduce or eliminate market risk, hence the name hedge. Their goal was to generate steady, positive returns regardless of market direction, what's called absolute return.
Today, hedge funds span an enormous spectrum of strategies, from genuinely risk-averse absolute return funds to highly leveraged, aggressive traders. What they share is a set of structural characteristics that distinguish them from conventional investment funds.
Hedge funds are unauthorized and unregulated. They can't be marketed to ordinary retail investors. High minimum investments, typically $100,000 or more, sometimes over $1 million, restrict access to wealthy individuals and institutions. Investment flexibility is their defining feature. Free from most regulatory constraints, they can go long, go short, use leverage, trade derivatives, invest in illiquid assets, and use almost any strategy they wish. They typically impose a lock-in period of 1 to 3 months before investors can redeem, maximizing the manager's flexibility. And their fees are high, typically 1 to 2% of assets under management per year, plus a performance fee of 18 to 20% or more of profits above a high watermark.
Let's walk through the main hedge fund strategies. Fixed income arbitrage, or FIA, seeks to exploit pricing inefficiencies in interest rate markets. For example, if the yield curve is expected to steepen, with long-term yields rising more than short-term yields, the strategy might buy a 2-year government bond and sell a 20-year bond, profiting from the relative price movements.
Market-neutral strategies combine long and short positions to achieve zero net market exposure. The return comes entirely from stock selection, identifying individual stocks likely to outperform or underperform, rather than from the overall direction of the market. A classic example is pairs trading, going long on one oil company and short on another, profiting from the relative performance between them regardless of whether oil prices rise or fall. Convertible arbitrage exploits mispricing between convertible bonds and the underlying shares, typically combining a long position in the convertible bond with a short position in the shares.
Statistical arbitrage, or StatArb, uses quantitative and statistical models to find pricing anomalies and mean reverting patterns in securities. Event-driven strategies seek to profit from specific corporate events. Merger arbitrage involves buying the target company's shares and shorting the acquirers after a deal is announced, profiting from the convergence of prices when the deal closes. Distressed securities strategies invest in the debt or equity of companies in financial difficulty. And special situation strategies exploit corporate restructurings or spin-offs.
Directional strategies take explicit views on the future direction of markets. Long-short equity funds build portfolios of both long and short positions based on individual stock assessments. Global macro funds, made famous by George Soros, who famously shorted the British pound against the Bank of England in 1992, take large positions based on broad macroeconomic themes across currencies, interest rates, and indices. And systematic or quantitative strategies use mathematical models and algorithms to identify and exploit market patterns, sometimes called black box strategies because the underlying models are proprietary and not disclosed to investors.
Section 7. Private equity. Private equity is medium to long-term investment in companies that are not publicly listed on a stock exchange. In return for providing capital, the private equity investor receives an equity stake and a share in the company's future growth and profitability.
Private equity takes several forms. Venture capital funds early-stage and high-growth companies, providing the capital needed to develop a business from idea to scale. Growth equity backs established but fast-growing companies looking to expand. Buyouts involve acquiring a controlling interest in a mature company, often using a significant proportion of borrowed money, known as a leveraged buyout. The private equity firm earns its return primarily through capital gains on exit, when it sells its stake. That exit might be through a trade sale to another company, a sale to another private equity firm, a management buyout, or an IPO on a public stock market.
Private equity is structurally different from public market investing in several ways. Liquidity is very low. Private equity investments are typically held for 5 to 10 years with very limited ability to sell in the interim. Returns are lumpy and uncertain, concentrated in the exit event. Access is typically restricted to institutional investors and very wealthy individuals, and private equity is usually structured as a limited partnership, with the private equity firm as the general partner managing the fund and investors as limited partners with limited liability. The appeal, despite these constraints, is the potential for returns that significantly exceed those available in public markets, particularly for buyout funds that can create value through operational improvements, financial engineering, and strategic repositioning.
Section 8. Sukuk Investments. Our final topic in this chapter takes us into the world of Islamic finance, specifically the sukuk, the Islamic equivalent of a bond.
Islamic finance is built on Sharia law, which prohibits two things central to conventional finance: riba, the payment or receipt of interest, and gara, excessive uncertainty or speculation. Because traditional bonds pay interest, they are haram, forbidden, under Islamic law. Sukuk were developed to provide Sharia-compliant fixed income-like investments. The fundamental difference between sukuk and conventional bonds is this: a conventional bond represents a debt obligation. The issuer borrows money and pays interest on it. A sukuk, by contrast, represents partial ownership of a specific underlying asset or project. The return to the sukuk holder comes not from interest, but from the income generated by that asset: rents, profits, or similar returns.
Islamic banking is asset-backed, meaning every financial transaction must be linked to a real, tangible underlying asset. The source of funding and business activity must also be Sharia compliant, meaning no involvement with interest-based finance, gambling, pornography, tobacco, or speculation.
The most commonly used sukuk structure is the sukuk al-ijara. Ijara means lease in Arabic. In this structure, the originator, say a government or a company, transfers ownership of a tangible asset such as property, aircraft, or ships to a special purpose vehicle, which then issues sukuk certificates to investors. Each certificate represents an undivided ownership interest in that asset. The SPV then leases the asset back to the originator for a fixed term. The rental payments from the originator flow through the SPV to the sukuk holders as their return, analogous to a coupon in a conventional bond, but technically a rental payment. At maturity, the originator buys back the assets and the sukuk holders receive their principal back, not as debt repayment, but as the sale proceeds of an asset they owned.
The sukuk market has grown substantially in recent years. There is now an active primary market for new sukuk issuances and a growing secondary market, particularly in the Gulf region and Malaysia. A growing number of Sharia-compliant investment funds give broader investor access to sukuk alongside other Sharia-compliant securities.
Let's bring it all together with a recap of Chapter 4. Collective investments exist to make diversified, professionally managed investing accessible to individuals who couldn't achieve it cost-effectively on their own. The pooling of resources delivers economies of scale, diversification, access to professional management, and liquidity.
Open-ended funds, including mutual funds in the US, SICAVS and FCPS in Europe, and unit trusts and OEICS in the UK, expand and contract in line with investor demand. Their prices are based on NAV. UCITS is the European regulatory framework that allows authorised funds to be sold across the EU and beyond. Open-ended funds come with various fee structures: initial charges, exit charges, annual management charges, and the ongoing charges figure being the most comprehensive measure. Funds of funds and manager of managers structures offer diversification across multiple fund managers.
Closed-ended funds, investment trusts, and investment companies issue a fixed number of shares at launch, which then trade on a stock exchange. Their market price can differ from NAV, trading at a premium or discount. Unlike open-ended funds, they can use gearing, and their managers are insulated from investor flows. Split capital trusts offer different share classes for income and capital investors.
ETFs combine the diversification of funds with the tradability of shares. Most track an index using physical or synthetic replication. They offer low fees, transparency, and intraday liquidity. Smart beta ETFs blend passive and active approaches. ETCs give similar access to commodity markets.
Structured products combine bonds and derivatives to create customized risk-return profiles, offering capital protection in exchange for capped upside. There are three types: structured deposits, structured capital protected products, and structured capital at risk products, or SCARPs. Key risks include counterparty risk, illiquidity, embedded fees, and potential lack of deposit protection.
Hedge funds pursue absolute or market-beating returns using strategies unavailable to conventional funds: short selling, leverage, derivatives, arbitrage. Strategies include fixed income arbitrage, market neutral, convertible arbitrage, statistical arbitrage, event-driven, long-short equity, global macro, and systematic approaches. Access is restricted to sophisticated investors due to high minimums and regulatory status.
Private equity provides medium to long-term capital to private companies, structured as limited partnerships with high minimum investments. Returns are generated primarily through capital gains on exit. Liquidity is very low.
And sukuk are Sharia-compliant investment instruments representing partial ownership of an underlying asset, generating returns from asset income rather than interest. The most common structure is the Sukuk al-Ijara, which uses a lease arrangement to generate returns for investors in a manner compliant with Islamic law.
That's episode 4 of Money Matters in the books. Chapter 4 is a fascinating one. It bridges the gap between raw asset classes and the real-world vehicles through which most people actually invest. Next time, we head into Chapter 5, Economics and Investment Analysis, where we'll explore GDP, inflation, interest rates, fiscal and monetary policy, and the analytical frameworks used to assess investments.
Thank you for listening. Until next time, keep building your knowledge, and I'll see you next episode.